going to, so this class is going to, we're going to move pretty quick. So we'll try to get our attention dialed in. 'Cause it's going to move pretty quick. And the first thing, I just want to, does everybody in here know what a loan is?
Yeah.
Right on. Okay. All right. So here's a question. We're just going to hop right in. We're going to move. So the first question before we start, I'm going to give you a situation. All right, here's a setup. Let's say that you can borrow money from your parents at 10% per year. And there's a kid at school, he's selling potato chips, Flamin' Hot Cheetos, whatever the rogue kid in your school is selling. He can't afford the inventory. And he says to you, can I borrow $100 from you for inventory? I will pay you 50 cents a week. And after 1 year, I'm going to give you back your $100. What would you do here? What could you do here?
You can lend it to him and take your parents' money.
Okay, and what would happen?
You'd have to pay your parents' money back, and I'm guessing you're probably going to lose money on it.
How much? Okay, so how much? If you borrow, first of all, how much would you borrow from your parents?
$100.
$100. Okay.
You'd have to pay back $110.
You got to pay back 110. Now, could somebody else tell me how much money you're going to get from the potato chip kid?
$182.
182. How did you compute 182?
I do 50 cents times 365. Or no, times 51. Right? Oh, maybe.
You're going to get $26.
No, it's 50 cents times like 365 days a year. No, because it's every week. Oh, every week.
That's right.
I didn't think
So
about
$26.
that.
So it's 50 cents for 52 weeks. So you're gonna get back 126. Okay? So alright, so who can tell me the profit? Go ahead. You made $16, okay? So you borrowed 100, you paid back your parents the 110, you lent out 100, and you got 126, right? You made $16. Okay. One thing I want you to notice here is that you started with no money. You started with no money, right? So who can compute your return? Right? Like, well, because did you show up to the situation with any money at all? Right. What did you do? You matched up somebody you could borrow from and somebody you could lend to at the same time. What is your return?
Money.
But what percent return? Hey guys, back there. Stop. What's the?
Is there a percentage? Is it $0.16?
It's infinite, right? It's infinite. So this is like a really interesting case of a business move because it's basically, we call this an arbitrage. It's like basically you've created money out of thin air right here. Okay? You didn't need any money to get started. But that's not usually how things work. Okay, we already went through this. Now, we already established this is a pretty good deal. If you think about it in terms of what's your return on $100, it's 16%, right? You made $16 on $100. But really, that's kind of wrong because really your return is infinite here. So, we went through that. Here's what I want to talk about right on the bottom real quick. What are the risks to this? What could go wrong here? Somebody in the back. Declan.
He won't pay you back.
He won't pay you back. What are some reasons he might not pay you back? Tyler.
He doesn't sell the potato chips.
Okay, his business doesn't really work. Okay, Maddox, what else?
He doesn't have $100.
He doesn't sell enough potato chips, right? Okay, Daniel.
Maybe he has the money, but then he uses it to buy something else. And
Okay.
Gets the payback.
So he's basically not trustworthy, right? He kind of ripped you off, right? Like maybe he has it and he's just not going to pay you back. So that's a risk. What's the best thing that could happen? I'm trying to keep it moving around. Zach, go ahead.
He
Right, and what would happen when that if he does that? What would he get?
The $100 in interest.
So you made a $16 profit, right?
Yeah.
The best case scenario here with this is you make your $16, right? Okay, I just want to keep that in mind. Now, what if we make a different proposition to this kid? And we said to him, hey, I'll give you the $100 that you need for your inventory, but you don't have to pay me back. Instead, I want a percentage of your profits. Okay? Forever. And you don't have to give me the 100 back, but I want a percentage of your profits forever. Here, you're no longer a lender. You are taking the position of an owner. You want to take an ownership in this business. Question is we already, no, that math on there was wrong, but the question is which deal would you rather do? Would you rather be the lender, or do you want to take an ownership in the business? You guys have any opinion on that? Does it depend on anything? Tyler.
How good the business is gonna do, like what he's selling to, how many people he's going to sell to.
Exactly. So the main point is it's kind of ambiguous whether you want to lend him the money or whether you want to take an ownership in his business. It could work out really good, but if his business isn't very good, you probably would have rather had your sure thing money back. So this question is, this is kind of what this is saying. First of all, if you did want a part of his business and you said, hey, I'll give you $100, but like Shark Tank, what do they do in Shark Tank? Who knows, in Shark Tank they offer, I'll give you $100 for what, Declan?
A share of the company.
Right, well what do they negotiate? What's the thing that they're negotiating?
Like
A percentage?
A percentage of ownership of the company, right? So you might say to this potato chip guy, hey, I'll give you $100, but I want 50% of your company. And what might he say to you?
No.
You say, I'll give you 5%, you might say, I'd give you 5% of the company, right? So all of this negotiation here comes down to basically how much profit you think this company can make that you're gonna get a piece of. So that's what we're gonna talk about today, is we're gonna understand the difference between being a lender and an owner, and we're actually going to walk through a hypothetical business, and we're gonna talk about what happens as different scenarios and what could happen in the business, and how you do if you were a lender versus if you owned a share of that business. And we are gonna step through the balance sheets and income statements, and you guys are gonna actually learn some pretty hardcore stuff here that you're gonna be able to take away with you, okay? So, says here on the bottom, let's meet the La Miranda Sneaker Company. Okay, this is, by the way, this is just a quick overview of the current plan here. It'll be 5 classes where basically by the end of this, you guys, for those of you that have a brokerage account and if you or have savings and want to invest it, you'll be able to open a brokerage account and actually buy shares of stock if you have savings where you can do that. And if you're interested in doing that, we will actually do this, and we will come up with a plan. Everybody's going to work on this. We're all going to come up with a plan for what you want to buy, and we're going to do it. So that's the goal here, is to actually take actions, not just learn stuff. Okay? So these are the 5 things, and you don't have to take notes. And these slides I'll share them with you after. All right. Part 1, how businesses work. So this is going to be the La Miranda Sneaker Company. Zach told me a sneaker company would be better than a lemonade stand, so here we are.
It's not true.
All right. You want to start a sneaker company. The problem is you don't have any money. Okay. First of all, what do you need money for? Right away. Go ahead.
To like start your business, get all the licenses and places to build a factory.
Yeah, you need a factory. You need shoes, right? You can't sell sneakers that you don't have sneakers. So we're gonna form a corporation. What we're gonna do is we we need to raise money in the beginning, right? So the first thing we're gonna do is we're gonna create stock. Okay, we're gonna create a company here. We're gonna just say, this Juan Miranda Sneaker Company, it's got 1,000 shares. We just came up with this magic number 1,000. It doesn't matter what the number is because the price could be anything. So we're gonna say we got 1,000 shares of this stock. Okay, and what we're gonna do is we're gonna say, I'm gonna sell I need cash, so I'm gonna sell 500 additional shares to somebody that I convince that I am a capable business person and I'm going to be able to make a successful sneaker company. I need to go out there and convince somebody that you're going to go there and you're going to wear a suit or a hoodie or whatever, and you're going to go in a room and you're going to say, this is my plan, I think I can do this, and somebody is going to say, you know what, I believe in you. You seem like a smart kid, good head on your shoulders. I will give you, I will pay $10 a share for 500 shares, let's say. So what they've done is they've given you $5,000. And what have you given them in exchange for that? You've given them 500 shares. You have 1,000. How much of the company do they have?
1/3.
They have 1/3, okay? So you have sold right off the bat, like Shark Tank, 1/3 of your company to these people for $5,000 right at the bat. Now when you have $5,000, you can actually start to do stuff. Okay, so this kind of walks through a little of the math, like kind of what I just said here. The total value of the company is $15,000. If he paid $5,000 for 1/3 of the company must be worth $15,000. Okay, let's say we need more money. We need a little bit more money than that, but we don't want to sell more shares. Because what's the bad thing about selling shares?
You like giving away more parts of your company, or like
Yeah, you're giving away more shares of your company. You're giving away upside in your company. You're giving away voting rights in your company, right? If you were to lose half your company, like you wouldn't be the majority shareholder anymore, right? So maybe we don't want to sell more shares. So instead, we're going to take a loan. So we're going to borrow money. This is called debt. So here, that, by the way, that thing there where you sell shares, you're selling equity. Equity means ownership. And here, you are taking on debt. You are saying, I promise you, I will pay you, in this case, we're going to borrow $2,500 more, and we're going to pay 10%. We say, I'm going to pay you 10% interest. Okay. Now, first of all, how much cash do you now have at this point? Go ahead.
7,500.
That's right. Okay. 5,000. So you are now, this is called the word for this is a capital structure. You have, your company is capitalized by $5,000 of equity and $2,500 of debt right now. And that's where you got the initial cash. Okay. And this is what it looks like all laid out on a very simple balance sheet. So balance sheets are saying, you can think of a balance sheet even as it's something that says, what are my assets and what are my liabilities? And then it all has to balance. It always balances, hence the name balance sheet, right? So here we have $7,500 in cash. Now, on the liability side, we have $2,500 because we owe that amount of money, okay? But we know that the company is worth $15,000, right? The shareholder equity, the value of the company is $15,000. That means that this weird fudge factor word is called goodwill is $10,000. This is sort of balances the balance sheet. And what it's saying is, this is the whole, what I call it like trust. Remember, this person said, I will give you $5,000 for only 1/3 of your business, and you don't even have anything at that point in time other than your word that I'm smart and I work hard. And that was enough. We call that trust goodwill. That's what they call it in accounting. So this is what your company looks like right now. It's $15,000 company. It has $17,500 in assets, of which $7,500 is cash. Okay? And the point here is that this always balances. Your assets will always equal your liabilities plus your equity. Okay. Let's move on from here. All right, we got to spend this money. We got $7,500. We need to spend some money because we want to make some money. So we want to buy first thing here, we're gonna buy a shop, right? We're gonna buy whether it's a pop-up shop, a retail kiosk, whatever you guys think is kind of cool, that'll end up like being able to sell sneakers out of. We're gonna pay $3,000 for this shop, okay? And then we need the sneakers, right? So we're gonna start with 800 pairs of sneakers, and we're gonna at $2.50, you're able to somehow make these sneakers for $2.50 a pair. So you have to spend $2,000 to get 800 pairs of sneakers. So remember, you had $7,500 in cash. You just spent $5,000 right off the bat. So we see that here. Now, the thing I want you to notice is your assets in the company did not change at all. All we did was we transmuted cash into things, right? We took all that money and we said, now I have $2,500 in cash, but I have $3,000 asset in terms of I have the shop, and I've got $2,000 of inventory, and I still have the $10,000 of goodwill. Nothing has changed. All we did was exchange cash for physical items. Okay, company's still worth $17,500. Okay. All right. Now we're gonna try to run this business. So let's say that we're gonna sell these 800 pairs of sneakers, and we're gonna sell them for $10 a pair. We're making them for $250, and we're gonna sell them for $10 a pair. Okay, and we need $5,300, let's say, to man the shop. You got to hire people to be salespeople. This is a different statement. Before it was a balance statement. This is your income statement. This is like what showing you your revenue and basically what it cost you to get that revenue, right? So here we had $8,000 in revenue, very straightforward. That's the 800 pairs times $10 a pair, minus the $2,000 it cost us to actually make the sneakers. Plus, we have this thing here called depreciation, because we want to think about what's happening in terms of like our profit and loss. And what's happening here is that $3,000 building we bought, the pipes break and the paint gets worn out, and it just loses a little bit of value every year. What we do is we say it's going to lose all of its value in 5 years. That's what we're going to say. That's our assumption. So every year we're going to lose 1/5 of that value. So that's $600. 1/5 of 3,000 is 600, and then our labor costs, the salespeople. Okay, so we have 8,000 in revenue, and after we take out depreciation, the cost of the inventory, and the labor, we're left with $100 after all this. Okay, that $100 is we call that. If we take the $100 and we divide it over, if you take the 8,000, so this is actually a very important concept. If you have $8,000, we want to say, how much of the revenue did I get to keep? Right? I sold $8,000 worth of stuff. How much did I get to keep? So I only got to keep $100 out of the revenue. So what you can do for margin is you say, margin is my revenue minus the costs that it took me to make that revenue, right? In this case, the inventory, depreciation, and labor, divided by the revenue again. And because that will give you it's basically thinking about it as what percent that I get to keep. So your margin here is only 1.3%. It's very, very tiny margin you made on this. You did a lot to just make $100 so far. Now, remember, we got this loan to that lender. We owe him $250. So I have $100 of profit, or I have $100 of operating income. Now I gotta pay this $250 loan, $250 of interest, So my earnings is I lost $150. So I've lost $150. And then less taxes, you end up with, because you actually get like money back because you lost money, so it's instead of paying taxes, you kind of get to reduce taxes. So the part's not super important right now. So your net income is $100, losing $100. Now, how many shares were in the company again? 1,500 shares, right? So you lost $100, and there's 1,500 shares in the company. So you lost 7 cents a share. You lost 7 cents a share. Okay. Now, big question here. We just lost $100 in the first year. just give up? Okay, what are we gonna need to do for this thing to get better? What has to happen for this to get better? What do you think has to happen? Sell more. We need to grow. Let me ask you, what do we need to grow? Do we need to, go ahead.
More money?
Yeah, but what do we need, what do we want to grow? When we look here, let's like just focus on the revenue. What are the levers here that make the revenue go higher? Hunter, go ahead.
Well, you could sell more pairs, you could have more stores, and you could raise the price. Or you could raise the price.
Trifecta. Bang. You can sell more shoes. You can sell the shoes for a higher price. And you mentioned you can open more stores, right? So that we can do more of that, right? So let's take a look at the next piece. Okay. So here's our growth strategy. Next 5 years. We're going to take any cash flow that we get and we're going to invest it right back into doing the same exact thing. And that means we're not going to pay anybody any dividends or anything like that. You're not going to take any money out of the business yourself. You're going to take all the money and you're going to put it right back into the business again. We're also going to raise prices. So we're going to try to get $10.50 a pair this coming year. And we're going to sell, our plan, we're going to sell more sneakers. We're going to sell 5% more sneakers, okay? So this, I already mentioned this depreciation, we can skip that. So these are going to be our assumptions that we can do this. And we're going to keep doing this every year for the next 5 years. What I want to show you is that pretty horrible looking situation we had in year 1, what starts to happen as we progress? So I just want to focus here on just year 2. Year 2, we go from, if we were selling 800 pairs before, we're going to sell 5% more. So now we're selling 840 pairs. Now at $10.50 a pop instead of $10. Our revenue in the store goes from $8,000 to $8,820. Okay, so our revenue is up 10%. Notice how it's basically up more, a little bit more than the 5% and 5%. So your revenue is up 10%. Your cost goes up. Your costs are going up a little bit as well. Your cost, and then your depreciation is fixed. Your labor is fixed. Okay, at that store. Okay, so now what's happened is your store EBIT. Remember, EBIT was this number right here. It was $100 before. That was basically taking your revenue minus your cost, and now look what happened. Your EBIT is now $820 instead of just $1 on this store. And the point there is that your margins went from 1.3% to 9.3%. Why? It's because we grew our revenue and our costs mostly stayed the same, right? So it's improving the efficiency of the store, right? Now, here's what happens if we open a second store. We expand to the new store. So now we're gonna use those numbers there, and all we're doing is saying we're doing that for 2 stores. So here we have 8820 a store, but we have 2 stores. So now our revenue is 17,640, and then our costs are taking out our $4,200 in our costs. Now we have the depreciation for 2 stores instead of just the 1, and then remember, we have another store, that means we have to pay a whole other sales crew, $5,300 for them as well. So now our EBIT for the whole enterprise is $1,640, a margin of 9.3%, and we still just need to pay that one lender his $250 of interest, and then now we actually have taxes to pay. So after taxes, our net income is $900. $900, how many shares of the company there was? It was 1,500 shares of the company. So $900 divided by 1,500 shares. Interesting. Our earnings per share on our stock is that we're now making 60 cents a share on this company, right? So we went from a negative profit where we did so bad that our taxes were actually a credit to now we are making money and paying taxes, and we've got $900 profit, and our earnings per share is going up. Now we just basically do that. If we just do that again every year, you can kind of, I just want to show you what it ends up looking like. So this is just following the same logic, but every year we're opening. Let me see. Oh yeah, our pairs per store is just going up 5% every year. Notice it's a very big impact, right? 5% a year. We're more than 20% more shoes in 5 years. So we've now sold over 6,800 pairs of shoes. Your net income in year 5 is $15,000. Now notice, what was the value of your entire company at the beginning? It was $15,000. The person paid you $5,000 for a third of your company, and your company was worth $15,000. Now you are making $15,000 in a single year, right? So your company must be worth way more than $15,000 today, because now you can just make that in 1 year. So, and then if we follow that earnings per share, remember it was 7 cents a share, now it's 60 cents a share. We know there's 1,500 shares out there. We just made $15,000 on 1,500 shares. We're now making $10 per share. Okay? You guys think that your original, the person who bought those 5,000 shares, you think they're pretty happy right now? Yeah, I think it sounds like they're going to be pretty happy, right? So, they spent $10 a share, and they're now getting $10 a share out of the company in a single year. So this is working out very well for them, right? One thing we do have to kind of always be aware of, there is a third statement, because we talked about the balance sheet and the income statement. There's another one called the cash flow statement. And this is really important because you could be running a profitable business, but if it's actually not spitting off any cash, you won't be able to pay your bills, and that will be a big problem. So we also need to keep track of our cash. It is possible to actually run a business that is profitable that has negative cash flow, or a business that grows that has negative cash flow, but we don't really want to go in that direction. So this is just our cash flow statement, and you can kind of see it's just taking our net income every year, and what we're doing is we're adding back the depreciation. That's what's happening. The reason is, remember, depreciation was like kind of this, it's not a fake thing, but it's not cash going out the door. Remember, you bought the store for $3,000, and then we depreciated it by $600. But that $600 didn't actually leave your pocket, right? It was an accounting thing to just make us be aware that the value of this store is going down over time, and that you don't want to overstate how much you think you're making by not taking into account that you're going to have to fix things with your store. But you never actually lost the $600. So this gets added back in the cash flow statement. So that's how we end up with, this is the total amount of cash that we've brought, and then our CapEx, which is how much we spent on the stores over time. We bought the store every year, so we've spent $9,000. And then I explained the depreciation. Good. I just wanted to make sure that you were aware of this cash flow statement idea. So this is, again, just recapping what happened. Things have worked out really, really good. Our first, and one thing, we kind of covered these other ones, like how much money it's made and the earnings growth. But the really neat thing is that in the year 1, our margins were only 1.3%. By year 5, by having our revenue grow and our costs grow at a slower pace, our margins have now improved to 28.6%. So we are now keeping 28% of everything that we're selling, we're actually keeping in our margins. And then our fixed costs will get deducted out of that. It's really important to think about your business in terms of margins. Now, this is kind of repeating a lot of the same stuff, but okay, who made money? This is what one thing we want to zoom in on here is the person who lent the money. They put up $2,500 and they got $250 of interest. But how much money did they make? They only made $250 every year, right? So they didn't really benefit from the fact that your company grew and grew and grew. The truth is, if your company grew half as fast, as long as it didn't go out of business, they were gonna make the same amount of money. They still would have made their $250. So they didn't really participate in the fact that your business did really, really well. However, the person that put up that $5,000 to buy equity in your company, they've made over 100% on their money, right? Now, they took more risk because if your business did half as good, they would have made a lot less money. Whereas, like I said before, the person who lent you the money, they don't really care how good your business does. They just care that you're going to be good for them, that you're going to be able to pay them back, that you still exist, right? So they're taking more risk, but they get more return, right? They get more reward for taking the risk. Okay. This is just a bit of, I just want to reinforce the idea that the less risk you take, the less reward you can get. There's all kinds of ways of borrowing money. Your parents may have a mortgage on their house, right? Which means that they borrowed money from the bank to buy their house. If your parents cannot pay the mortgage on their house, the bank has the right to take their house from them, and then they would sell the house and be able to get the cash from it, from the sale of the house. That's what secures the loan. It's collateral. This is the problem we had before with the potato chip guy. You go to the potato chip guy and say like, hey, you promise you're going to pay me back? He's like, yeah, I'll pay you back. Well, you're like, I don't know if I really trust you. I think you need to pay me 10, 15% interest because I don't believe, I'm like kind of a little sus on you paying me back here. But what if he says, what if potato chip guy told you, I have this really nice, I got this really nice gym bag. You know, the gym bag's worth $80. If I don't pay you back, the gym bag is yours. And obviously you still have to trust them there, but let's say there was a contract about it where there was a neutral third party. You went to the store, the notary, and the notary says, oh, I've seen this contract and this is a real deal. If you don't pay him, he's got to give you this gym bag. That's exactly how all debt works. There is the most risky debt is this, like, they call it like something like debt that's not backed by any asset. It's not backed by any collateral. But most debt, like a mortgage, is backed by, hey, I'm going to pledge my house against my loan. I'm good for it. You can take my house if I don't pay you. Somebody that's lending to that is not going to require that high of an interest rate because there's an asset that's backing the loan as collateral. If you're just taking somebody's word as bond, like, you're going to need a lot of interest rate to compensate you for that risk, right? Okay. So, and then the least risky thing is borrowing is the U.S. government, right? Because the government, even if the government could just print money and give it to you, so they can always pay you back. So there's no risk in giving the government money, and that's why the government interest rate is the lowest interest rate there is. If you buy, when the government borrows money, it doesn't really have to pay a lot to borrow because it's good for it. Okay. Alright, so now what we're going to do is we get a chance to actually watch how this stuff works together. I'm just going to give you guys. Alright, I need somebody that's going to be able to roll the dice. Alright, we made this example and things were really nice. Everything went up and to the right, as they say. Everything worked out, everything grew. But that's not how business works necessarily in real life. We don't really know how things are going to work out. So what we're going to do right now is we're going to start with the same exact assumptions as we had in the beginning, where we're going to pay, the shoes cost $250 a pair. You're going to you have a fixed cost of $5,900 a year. You have a depreciation expense of $600, tax rate, the liquidation discount I'll talk about later. You're going to still borrow $2,500. Okay, and so what we find here is same situation. There's equity. you've raised $5,000 by selling it on Shark Tank to this one person that said, I believe in you. And the initial value of your company is 15, well, we said 15,000 before, but that's because if you actually do 33.33333, you get this $15,015. So that's the actual math. Our share price is $10 a share. Remember, 1,500 shares times $10, $15,000 company. Everything is the same. We start with that $7,500. So here's what we're gonna do. You are gonna decide. You guys decide how much you want to try to sell these shoes for. So we said they're $10. This is a demand curve over here. Now I would look at that demand curve and try to figure out how much you think you want to try to sell these shoes for. And then what we're going to do is we're going to just roll the dice. And when we roll the dice, we're going to look at this. I had it here somewhere. Is there a dice table? Sorry guys. Does anybody see the dice table?
Inputs?
Oh, there it is. Okay. Let's grab this thing here. Go over here. Sorry. Okay. So in a typical year, we're going to sell 800 pairs of sneakers. But the dice are going to tell us what our fortune is really going to be as far as how much we're going to sell. Okay? If we roll a 6, whatever, there's a viral TikTok campaign, or by the way, this is like the ChatGPT helped me make all this, right? So, it decided that a TikTok viral campaign happened, and so you're going to sell 1.4 times or 40% more shoes than our basic year of 800. So you're going to sell. Who can do that math real quick? If you sell 1.4 times 800, how many sneakers is that? 1120. Okay, I'm gonna take your word for it. All right, so you'll sell 1,120 pairs of sneakers that year if you roll a 6. So the question, we can't control what happens to the dice, but we can control how much we're going to sell these sneakers for. So you tell me a price that you want to try to sell these sneakers for in year 1. And when you look at that demand, actually, I'm curious what your opinions are when you look at the demand curve. Does anything stand out to you?
How many times do you get to roll the dice?
Well, we're going to roll the dice once for every year.
Oh.
So we're working on is year 1 right here. And I want to know, when you look at that demand curve, where do you want to price your sneakers? First of all, real quick, just if you price your sneakers higher, are you going to sell more or less than 800 shoes? Less. You sell less, right? So you look at that demand curve. What do you guys think? Go ahead, Matt.
Is that a guaranteed pair sold, or is that like a possibility?
This is that will be the base amount that you would sell, but and then the dice is going to put the multiplier on it. So that's going to be your base amount. Go ahead.
I would do $8 for 1,100 pairs sold, because if you multiply it, you get a higher number, and you could advertise to investors that you sold over 1,000 pairs in 1 year.
Okay. Any other opinions on how much you want to sell? Where you want to price these sneakers? So, Hunter did a really good thing here. He just did the very sort of the obvious thing that one might do there, which is just to multiply the price times the pair sold to be like, what would my total revenue be in every one of these conditions? How much would my revenue be? When I looked at this, which is it's kind of funny because I didn't actually think to do that. When I looked at it, I just thought to myself, well, if I sell my shoes for 10% less, I end up selling more than 10% as many shoes, right? Because if I only sold 880 pairs of sneakers, I've sold my shoes for 10% less, but I've sold 10% more. But here I'm actually selling even more than 10% more. So I must be better off. Likewise, if I raise my price by 10%, notice how your volume drops by more than 10%, right? If I raise the price to $11, for me to be indifferent, I would want the pairs sold to only drop to 720. That's like the first thing I looked at when I saw that, but it is effectively the same thing as what Hunter did, which is to multiply both columns to get the revenue.
So
Okay.
your fixed cost decreases the higher up the price goes based on pairs sold, correct?
That is a good point. Well,
Because you have less.
you would be
shooters to
selling
produce.
less shoot. You would be, yes, because you would need less shoots to sell.
There's some kind of like,
Lever there.
yeah.
Well, let's find out. Let's actually see what happens. So we're gonna go. So does everybody want to go with Hunter's plan? He's gonna be the merchandiser, and he's saying we're going $8 on these shoes. We're going at the low end of the market here. All right, the budget item, $8 a shoe. You roll the die, Hunter. Let's see what happens. Hope no one. All right, sweet. We get a 4. Okay, what's 4 say here? Normal year, no multiplier, right? Okay, so this is kind of what we expect, because it's going to be like the case in the example, because the multiplier is just 1, and we're actually selling more shoes. We should be doing better, right? So our base demand was 1,100 sneakers. Based on this, there's no multiplier at all. So we sell 1,100 pairs of shoes. So $8 times 1,100 we make 8,800 in revenue. Our cost of goods so we have 1,100 pairs times $2.50 a shoe. That's our $2,750. So our gross profit was $6,050. That was our gross profit from all the units that we've sold, but now we have to take out our fixed costs, right? Because we're running the store, and we said that that's $5,900. So our EBIT for year 1 is $150. Our EBIT margin, that concept that we went over before, we only had 2% margins. It's a pretty small amount of margin, but at least it's positive. So we made 2% margin. We have to take out our interest expense, which is the $250 loan. So our net pre-tax income is losing $100, and there's no taxes. We've lost $100. What happened to our balance sheet? Remember, we started the year with $5,000, okay, and we had $2,400 in assets at the end of the year. It's the $3,000 shop minus the $600 depreciation. So our assets is $7,400. We have $2,500 in debt, which reduces the value of our company. So our company's book equity, this is like if you take all of our assets minus our liabilities, our book equity is $4,900. $4,900 divided by 1,500 shares, our book equity is $3.27 a share. That is, if you were to just look at the company as based upon what is this company worth, just based on what it has, $3.27 a share. Okay, that's year 1. Now,
But can I ask a question? Because
Go
he
ahead.
actually,
Yeah, go
he
ahead.
was like, what'd you ask? What'd you ask me? He said what? He said what? He was just curious what would happen if you did in that same thing $10 or $14 in that same, because the
Yeah.
cost of goods could change.
Let's see how much it changes. Let's actually put this to 10, right? We do expect the cost of goods sold to go down, the COGS to go down, because we're
Right.
selling less units. Let's see if it does that. It says $2,750. I'm gonna hit the button. Yeah, it drops to $2,000.
So you're even worse off.
You're actually worse off, right? Because we know that our revenue is best when at the lower price, and even net of the fact that the cost of goods goes down, we would have been worse off. So Hunter did a good job here with pricing it at $8 a shoe. Okay. Now, one thing is here that I want to mention. That $3.27, that's the accounting value for what this company is worth. But let's go back to the very beginning when we went to this person and said, trust me, I'm smart, I can make you some money. What was the accounting value of the company at the very beginning? When you just show up with an idea and you haven't raised any money yet, What is the value of your company?
$10,000.
It's $10,000. It's $10,000 on faith. It's like a very important concept here. Your company was worth $10,000. It doesn't even have any assets. It's actually worth zero. Its book equity at that time would have been zero, but somebody believes in you, so they say, "I'll be willing to give you or I would value your company at $10,000 of sort of faith value, just because I believe in you." Okay, it's just I don't want that to go overlooked. So here, when we computed the book equity of $3.27, that's only based upon what the company's value is, based on what's on its balance sheet. But if it was a stock trading out there in the world, if it was something that it would probably be worth more than that, because if you just value the company at $3.27 a share, you're completely discounting the value of the fact that somebody's there that says, "Hey, I'm smart. I'm going to make you more money." Like, that would be paying nothing for that person's willingness to do that. Like, I have a feeling I would pay more than $3.27 a share for this company, because I believe the person running it has got a plan, and they're going to grow this company. So this is why companies will trade for a higher price than what's just on their books. What's on their books is just almost like the minimum of what it's going to be worth. Because that's like, if you were to just sell everything today, you would end up with $3.27 a share. But it's got to be worth more than that, because you believe that this company can make money with these assets. So what we're going to do here is we're just going to say, you know what? I'm willing to believe that I'm going to pay 10 times as much as the book value of the company. I'm going to do that. In the beginning, I was willing to pay infinite as much, right? Because the company's worth nothing, and I'm just willing to give the guy 10 grand or gal 10 grand. So here, I'm just going to say that the company is, I'm not sure if I did that math right, but this is a number that we get to make up, how much we think it's worth. So we're going to say, I'll be willing to pay 10 times more. So, okay, let's go back to this again. Year 2. Do we want to change the price of the sneakers at all? We want to keep them the same? Alright, we're going to stay in this market. Alright, let's give the dice a roll. Let's see what happens. Six. TikTok viral campaign. Woo! All right. So what's gonna happen? We're gonna sell as here. Let's predict the number here. In a normal year, our base rate is 1,100 shares, but we're gonna sell 40% more. So how many pairs of sneakers is that? Mental math, anyone? 1.4 times 1,100. 14 times 11, anyone?
1540.
1540. Okay. So we're gonna go ahead and we're gonna put the 6 in there. All right, and there's that pair sold, 1540. Thank you, verified. All right. So this is a good year. So we're gonna end up making $2,570 in earnings before in EBIT, which is basically taking your revenue minus your cost. We made $2,570. Look what happened to our margins. They totally explode here. They go up to 21%, and our net income for the year is now $1,740. But what I want to follow down to is, what does this mean for the balance sheet? What does this mean for the value of the company? Okay, so now the company's got $7,340 in cash. It has the value of its shop went down another $600, so it's $1,800. So its total assets are now $9,140. Has the same amount of debt. Now, the book value of the company has went up by about a third. We went from $3.27 a share to $4.43 a share after having this really good year. Over here, we're going to keep this multiple. Sorry, at 10. And then what we find is the share price now is $11.60, right? The original share price was $10, so the share price is now higher than that. We're gonna just continue, so let's just rip through these. What I'm gonna do is we'll keep the shoes at $8. That's been going good for us. Roll the die. We'll run it through. So we want to see what happens to your share price. So we got a 3. What's a 3? That's a bad weather. People want less shoes, I guess. You're gonna sell only 85% of your base rate. So your net income in this year is you're gonna lose $1,000. Okay. We lost $1,000. Our share price dropped again down to 376. All right, and then we're gonna do year 4. Do the same thing. Give it a roll. Hopefully no bankruptcy. No bankruptcy. What'd you get? 2. All right, another bad year. We're not bankrupt, but it's another bad year. We lost $1,900 that year. So one thing I've noticed here. Remember, at the end of this loan, we're gonna have to give that lender back how much? We're giving them $250 a year, but at the end, what do we have to give them or her?
2,000.
We have to give them back we got to give the lender the principal back, right? So I'm just taking note here. Our cash is only $5,600. It's going to be it's not going to be great if we have another bad year, because we're going to have a big payment to give at the end of year 5, right? So continue just doing that. All right, and then year 5, we're going to go same thing, $8, and go ahead, give it a roll. Let's see. 5. All right, salvation. Okay. All right. So what happens here? We end up making the company's value goes back up again, and the book equity is $3.03. And what we're going to do here is we're going to go over and we're going to look at. Right. Okay. We're going to go down here and look at the results of what happened to the lender and what happened to the equity owner. So the lender, well, the company always was able to make their payments, right? So they never went bankrupt. So they managed to get their payment every year. So they got their $250 a year, and after 5 years, they've made their $250 of interest a year, and doesn't show it here, but they would get their $2,500 back if it was a 5-year loan. Okay, so that's the lender's result. How about the equity, the stock investor? What happened to them? They owned a third of the company. Okay, and a third of the company was worth only $1,632 in year 1, right? So remember, they're buying a lot of hope. When they spend $5,000 for that company that doesn't have anything yet, they're buying a lot of hope. And the company starts to make its revenue, and it's like, okay, it went from being a nothing in like to 1632. Then it was 5-7. This is the only time the investor was actually up money on their investment, right? They put $5,000 in, and the value of their company was $57.94 at the end of year 2. But then the prospects for the company went right back down again, and then in the end, the value of the company was $1,515, something that they paid $5,000 for. They lost, and this is like year by year, how much their return was every year from the 5,000. And we can see that cumulatively they've lost 70% of their money owning this company. So who did better here, the lender or this equity investor? The lender did better, right? So in the first example we did before all this, it was great to be the equity investor because everything went up and to the right. We grew 5% on our prices every year, 5% on our sales every year, which meant 10% growth every year for 5 years. Fantastic result for the investor, for the equity investor. This time, the company didn't go bankrupt. It was perfectly viable business. It worked, but it did not work as well as the expectations that were laid out for it. And we didn't, this was, we rolled the dice here. I did not contrive this. This is, you can play this game multiple times and see exactly how it would play out for the investor, for the debt holder or the equity investor. So, does that make sense?
Chris, can you just put the multiple in that last one on the
Oh,
valuation?
yeah.
Does that change the investors?
So the price to book, so actually what happens is it says the share price, what is that formula, R17 over 15.
So
Oh,
it
that's just
changes.
taking
Yeah.
the market value of the
It's
equity.
still a loss, but it's not
Yeah.
that of a loss.
Yeah. 40,
It goes
45%
up 45%, right?
instead of 70.
The
Over on the far right.
Well,
Oh yeah, okay,
Like
yeah.
mine.
So it's not as bad. So that's because, and the reason why this is better when we put the multiple in there is because what this is saying is the stock hasn't went down to its book equity because people still like, well, this thing still exists. There's still a management team here. There's still an opportunity. This company can still grow. We still believe in these people. So they're not discounting the company, but this is what it would look like if. Now, what if investors lost faith? They said, you know what? I'm not as hyped up on these people as I used to be. I'm not willing to pay 10 times the value of the company anymore. I only think it's worth 5 times its book equity. And if we do that, we're back to losing the 70%. And that's because what we can say is the company was a word that they use here is it was re-rated. It was reassessed. It's like, I don't believe in these people as much. Sometimes if you guys are looking at the news or looking at like companies that are very popular, you know, for a long time, Tesla is like a very good example, or Amazon's a really good example. These are companies that at the very beginning, their net income every year was losing money, right? But their stock prices would keep going up because people are believing in the future of the company, and they were more focused on the future of the company than what its current results are. That's a lot like what the year one is here, whereas the results don't justify the value of the company, but it's hope that is driving the value of the company. So that's when you see that kind of thing, where you see like, oh, this company lost 10 cents a share, you ever see something like that, and its stock price doesn't go down, it's because the beliefs about the company have a larger weight in the investor's mind. It's like, hey, maybe they hired somebody that's some genius, and they're like, you know what, that person's going to redesign these things, and we're really excited about the future of this company. So the current results are not our focus; it's the future that we're looking at. So that is pretty much going to see. So what I'm going to do is I'm going to give you. I'm going to send you guys all the links. I think this is stepping through this yourself is very instructive, and what you can do is what I would like for you to do is a very simple homework assignment. Simple homework assignment. Choose 3 industries. You can pick whatever industries they are. And I want you to find 5 or 10 companies in those industries and just report what their margins are. And then take the average margins for that industry. Because you're going to find, I kept alluding to this idea of a margin. A margin is a very important concept. Does anybody know what a low margin business is versus a high margin business? Has anybody have heard those kinds of expressions before? Go ahead.
Make your money back faster, but it's more risky for the high margin.
Well, what is an example of a high margin business?
Nvidia.
Nvidia is a really interesting one because they sell. Does Nvidia sell physical products or software? They sell physical products, right? Typically, hardware is pretty low margin. It's kind of like sneakers. Sneakers can be high margin. Luxury brands are high margin because if think about, like, actually an interesting one is cereal. Cereal is very interesting because what is cereal made out of? Sugar. And what else? Like wheat. Are sugar and wheat like expensive things? Not really. Is there any difference between the sugar and wheat over there versus the sugar and wheat over there?
Yeah.
But so in that box of cereal, you go down the cereal aisle. How many different cereals are there? How many colorful boxes are there? A lot, right? But what's inside those boxes? Is it a bunch of stuff that's actually different? They're just different combinations of sugar and wheat. That's all it is. Every single box is just a different combination of sugar and wheat. And yet, they can charge a lot of money for that box, right? Why do they charge so much for that box? Demand. But why does somebody want to, because what is it about that box? What is it about that particular box of cereal, of sugar and wheat, that you would pay for? Like, do you buy the Kirkland brand of oats, or do you buy Cheerios?
Why?
Usually Cheerios, probably, right? People pay a lot for things that are perceived to have where the brand is perceived to be better. Does Apple sell computers that are cheaper than the average computer or more expensive than the average computer? Way more expensive, right? So Apple's brand, now they have great engineering and great hardware, but the brand itself carries a cachet. If you go to anywhere in the world and you have an iPhone, in this country, everyone's got like an iPhone or a Pixel, but you go to other places in the world where people might have less money. An iPhone is a really big deal. It is a status symbol. It's like, you know, what we might think of as a Mercedes or a Ferrari, and the rest of the world, an iPhone might be a big deal. You could have people that are barely have enough money to eat, but they will spend their last dollars to get an iPhone. That is an amazing amount of brand power that Apple has, where it can sell you these same components as another company, but it can sell them for way more to you. They can make way more margin. Margin is the magic here. So what I want you to do is look at different companies and try to look up what their margins are. I don't care how you do it. You can find websites. You can, if you do use ChatGPT or AI to help you can do that. Then just make sure that it gets you see its sources. Ask it, give me your sources, and if it gives you your sources, take a look at them and make sure that it's just not hallucinating and making things up. And make sure that those sources are current. Sometimes it might tell you something and you look at it and it's like, but this is from 2017. It's not current, right? So I don't care if you use AI to do it, but just be sensible about making sure, or verify what you're looking at. That's it. Any questions? Crickets, nothing.
So you'll email this out to all
I'll send everybody all the materials, like the slides and like I said, I think stepping through the spreadsheet is pretty. First of all, does anybody here actually make spreadsheets at all? Has anybody ever made a spreadsheet? Yeah. Few people. Yeah. Is that for school? You have to do that for school? Yeah. Okay. And do you use Google Sheets? Is that? Okay. This is just so you know. I mean, just if you're curious, this whole presentation was made with AI. I mean, it was a lot of back and forth with it to get it to look like this. But I had the slides. I had an idea of what I wanted to do, but the actual coming up with it was made with AI. I used Claude to do it. It made it all for me. I imported the PowerPoint into Google Slides. In Google Slides, I could go down here and I could hit beautify this slide when it was in there, and that's how you were getting these slides that look like this. This is what happens after I hit beautify the slide. It did this. And that spreadsheet was also made by Claude. I told Claude I want to have a simulation that looks like the slide, because it knew what the slides were, right? Because I gave it a presentation, knew what the slides were. I said, I want you to make a spreadsheet that will allow us to tinker with the numbers so that we can see how this would work in a simulation. And it generated the spreadsheet. And then I took the spreadsheet and then that gave me a really, really good starting point. I was, 75% of the way there. And then I edited it from there. And sometimes I would talk to it and say, hey, I don't, you know what? I think you did this wrong, or I would like to add the ability to have we didn't talk about the liquidation value, but like I want to add that to the ability to it. I gave it back to it and it added that stuff, and then I just back and forth until I got it to be something that I wanted. All of this was made with AI, but with a lot of guidance. So, yeah, just there's it's easy to make things today. So you be able to demonstrate stuff for yourself. So,
Yeah, thank
anyway.
Teacher Chris. It was a great